Welcome back to the program. After more than 3 decades of dominating the market, the African pay TV heavyweight MultiChoice Group is facing an interesting if uncertain future. It's being discarded from one perspective by its globe-trotting parent, Naspers. Now, the parent company will spin off MultiChoice in the Joburg market next year, in the first half of 2019, to create an entirely newly listed company. Now, estimated valuations by analysts and investors range from anywhere between $5 to $6.6 billion, plus, of course, the potential for dividends, compared with zero as part of the wider empire in Naspers. All right, then, so let's dig a little deeper into what exactly this issue essentially will work on. Let's head over to South Africa now. Chris Hart is Executive Chair at Impact Investment Africa. He joins us now live from that city. Chris, good to see you. So from your perspective, how much is MultiChoice worth?
Yeah, MultiChoice could be worth up to 100 billion rand, which is, as you say, $6 to $8 billion. It'll fit into the actual top 40 companies on the JSE. The overall market capitalization of Naspers at the moment, its parent, is sitting at 1.4 trillion rand, and basically you're taking 100 billion out of that to create that company. That company will have a bigger market capitalization than companies like Anglo Gold and other big mining players. In other words, what I'm trying to say is that the combined market capitalization of Anglo Gold, Sibanye and Goldfields, which are the 3 biggest gold mines on the thing, won't actually top where MultiChoice is. So this is just to give you some perspective of this in terms of the value. Right. It will not really affect the top market capitalization of Naspers too much, because effectively it's a bit of a value trap in the sense that a lot of it, people will say, you're getting the DSTV for free when you're actually investing in Naspers, and this is one way to actually try and unlock value.
Right. Let's dig into that a little deeper, though, because Naspers shares are down about 4.3% in the last 4 weeks or so. They closed today lower by 0.83%. What is it about the firm's current structure that investors really do not like? Where is the value that's not being unlocked?
Well, I think the combination of its major holding in Tencent and the DSTV is in fact a little bit incomparable. DSTV is effectively older technology, and it is at risk of being overtaken by newer technology in areas like Netflix and the video on demand services that are popping up. The MultiChoice business will still be very strong because of its offering on sport in particular, and the video on demand service really does depend on bandwidth, which is still under construction. But once one's over that hurdle, the MultiChoice model does need to be revamped. Otherwise, it does risk in receding in its dominance.
Right. I'm going to get to that in just a moment. But back in July, when they released their annual report, the company said, and I'm quoting them here, that they aim to transform their video entertainment business. That was a key priority for them. And this is a business that's making money, trading profit of $370 million, revenues of about $3.7 billion. So why sell now if you want to transform the business? Well,
I think because there is a value trap, I think this is the main reason is that there's a value trap in that when you actually take the sum of the parts of the business, it doesn't actually add up to the whole of the business. In other words, the parent in Naspers on the market capitalization is not really worth as much as the potential of some of, if you actually unbundle some of these parts. And I think that's the major reason why one does it. And I think also another development in Naspers itself, that's the parent, is that DSTV MultiChoice has always been their cash cow. It's got a subscription base where basically if you don't pay cash up front, you don't have access to the television. So people pay that money up front, and it's been a tremendous cash cow. What we're now seeing is Tencent is also starting to generate revenue. So the actual need for the parent to actually have both is not as strong as it was previously. And I think that's one of the reasons why it actually is opportune to actually split it off, because the market cap of DStv plus as it gets unbundled from Naspers and the Naspers' residual market capitalization afterwards, if you add the two together, it'll probably be significantly more than what it is as a single entity at the moment.
All right, one last question for you, Chris. So the TV business, it's heavily concentrated in South Africa. 7 million of the 13 million subscribers they have are in that particular country. You, of course, alluded to the fact that this is a lot of old tech here. You've got these young challengers coming in, Netflix, iFlix, pretty much right across the board. Is there really a strong case here to invest in this business, given its weakness in the digital space?
Well, I think the investment case is more a short-term investment case, that it's got very, very strong cash flows and it's dominant in the market, and that for a sports-mad country, it still has the best sports offering by a long, long way compared to any of the rivals, including the national broadcast of South African Broadcasting Company. They just don't come close to what MultiChoice offers on the sports side. But as bandwidth is improving and data costs are coming down, this is actually quite a big threat to the business, and it does risk becoming obsolete in the next few years if it can't actually reinvent itself and also play in that space and actually transform its business model. It will have to. I think MultiChoice does have image challenges in the sense that it is very expensive to have the premium bouquet, and that subscription price has been rising, and there has been some disquiet amongst subscribers as to are there alternatives, and these alternatives coming through I don't think is a very high barrier for subscribers to actually switch.
Indeed. We'll leave it there for the time being. Chris Hart in Johannesburg, thank you very much for your time.